Welcome to the Zeiss Meditec 9 months 2024-25 results. I'm Sebastian, I'm the head of investor relations. I will take you quickly through the main messages around our quarterly results. We had a strong order entry this quarter and continued on the positive trend following the first 6 months of this new fiscal year with a 23% order entry, which is partially supported by the acquisition of the Dutch company DORC, retinal surgery specialist company. However, even adjusting for the acquisition, the order entry was quite strong at roughly 16%. That's a recovery of the North American region, as I'll show you, but it really goes across the board. Also, the European markets were quite strong, and we were able to finish the quarter at a pretty solid order backlog of 431 million, giving a further stabilization to our order situation following the weak calendar year 2024. Revenue conversion was a little bit behind order growth at 8% forex adjusted. Adjusted for the DORC acquisition, we got to 1% organic growth, so only a small amount of organic growth, which is partially due to delivery problems at the Microsurgery unit, which I will go to in a little bit on the segmental discussion. The good news is that these are mostly in the rearview mirror, and there will be an acceleration of the deliveries of the important new neurosurgical microscope in the coming fourth quarter. The KINEVO 900S, that's the neurosurgical microscope. We were able to ship a good deal. There was an improvement versus the second quarter, but a lot more is possible based on the strong customer interest that we're seeing. The VisuMax 800 installations in China are on a very good track. That's our refractive laser unit on which we're offering the so-called SMILE Pro technology, the latest version or latest iteration of the laser surgery, the minimally invasive method called SMILE, which is particularly an important technology in the Asian markets. In China, however, during the summer months and the start into the important summer peak season, we saw a slightly weaker procedure traffic environment. There was a slowdown again after the strong second quarter during third quarter, although we remained slightly above the previous year at the 9 months level, and we expect a stabilization now towards the month of August and September. As a consequence of the relatively soft top-line growth in reported terms, we did get an EBITA that was around 5 million or 3% higher than the year before. So we remain well on track based on the reported numbers to meet our guidance of a stable to slight improvement in EBITA. The margin, if adjusted for special effects in the previous year, 11.1% versus 10.2% was up almost 1 percentage point, even though, of course, the absolute level needs to increase further towards our midterm targets in the next 2 years to get to a corridor of 16 to 20%. Let's look at the ophthalmology division and quickly take a view on the margin progression and on the sales growth. The revenue growth in reported terms was close to 10%. However, this was mostly the already mentioned acquisition impact of DORC. The comps were relatively high. Previous year in Q3 in ophthalmology was stronger than in the other division of microsurgery, and there was a significant foreign exchange headwind with the Asian currencies, particularly Chinese RMB, devaluing quite a bit during the quarter. This was one of the reasons why we did get a lower growth rate. The DORC consolidation helped us to offset an otherwise relatively slow recovery on the equipment sales side. There was volume growth in the intraocular lenses in China, although prices were lower due to the tenders in the volume-based procurement, which had not fully annualized from the year before period. And we already discussed the somewhat weaker development in laser surgery procedures during the third quarter. Still, the EBITA margin could increase by 1.6%, which is not a bad result, even though the absolute level of the margin needs to increase further in the next few years with more recurring revenue. The growth in the refractive consumables business overall outside of China helped us with that. Also, the contribution from DORC, which has a somewhat higher profit margin than the average mix in ophthalmology, did contribute positively, as well as a tight cost control with the reduction, particularly in the R&D spending. The recurring revenue in this division, that means the revenue not from equipment sales, but rather from services and consumables, reached 60%, a new all-time high. We're quite proud of getting to these levels. This is not the end of the road. We can take this ratio further. Particularly the newly acquired DORC business has more upside as it's mainly a profitable consumables business. Let's look at the microsurgery business unit next. At the 9 months level, the FX adjusted revenue was up by 1.8%. However, the third quarter as a standalone quarter achieved about 10% growth. So there's clearly an acceleration as the deliveries of our important new product KINEVO 900S, which so far is still somewhat behind plan, did accelerate during the third quarter. Particularly the final month of June was a strong month, and we expect a further acceleration into the final quarter of the year until September. The product mix was unfavorable, mainly because there were less of the most profitable neurosurgical microscopes in the mix at the 9 months level. And also in Q3, the mix was still weaker than it should be. There is going to be, in our expectation, a significant reversal of the mix issue in the fourth quarter. So despite the EBITA margin being under considerable pressure in the 9 months period, as shown on this chart, at 12%, we expect the gap to the previous year to narrow substantially with the final quarter in the books, as we can deliver now more of the KINEVO 900S, which had some quality issues in the software affecting the demo devices used to place with customers before the final sale is made. Most of these issues have been removed and healed by the end of the third quarter. So there's really now green lights for good deliveries in the fourth and final quarter of the year. There was a slight increase in operating expenses, which should not be completely ignored in the third quarter period and the 9 months period in total, partly due to higher marketing and IT expenses. The recurring revenue in microsurgery is at close to 20%. It's a bit less than the ophthalmology division. We're working hard on our instrument strategy, and our innovation resources are partly focused on developing a superior instruments portfolio here, based in parts on the acquisition of Cogent in 2022 with the longer-term strategic goal to also drive higher the share of recurring business in this important division. Looking at the regional development, we see very solid growth both in Americas and EMEA, although a significant part of this does come from the DORC acquisition. In EMEA, the DORC acquisition contributes most of the growth. The Americas region is also substantially higher than last year, excluding the acquisition impact. Where things are a bit slower is in Asia Pacific right now, with only 1.8% growth rate, where we do suffer from a somewhat weak Japan, whereas the development in China and South Korea remains sluggish for the year, neutralizing the more positive trends in Southeast Asia and India. We expect China to stabilize and improve in the fourth quarter, so the likelihood is good that we can further improve this full year growth rate as we report the 12 months in December. Jumping to our outlook, the outlook for fiscal year 24-25 is confirmed. We expect moderate revenue growth, mainly coming from the DORC acquisition, with a small element, probably a single-digit percentage element of organic growth. Currency headwinds may imply that the reported growth, excluding the 100 million additional contribution from the DORC acquisition, will be very small or almost zero. EBITA and EBITA margin are expected stable to slightly higher this fiscal year. This outlook is confirmed. We have now a target of at least getting to the 248.9 million of last year, or to achieve slight growth against it, which would translate into an EBITA margin of around about 12% as we had last year, implying that the overall EBITA is at least going to be in the 250 to 260 million region for the full fiscal year. This does require that the Chinese market remains stronger, stabilized as we expect it to be in the July through September period, and that the deliveries of the new microsurgery product KINEVO 900S do accelerate as we are currently predicting in the fourth and final quarter, and we get a good output of these high margin devices during the final stretch of the year. The whole organization is working very hard to make sure the targets are being met. The introduction of the 15% trade tariffs by the US government on the European imports is impacting our earnings this fiscal year, likely in the high single-digit million area. There's also an embedded FX effect that will hit our fourth quarter earnings, which we also consider to be in the neighborhood of round about 10 million for the fourth quarter. This, however, we will together with the trade impact, be able to offset through pricing measures that we're taking. And we'll be able to neutralize most of these headwinds as we go into next year until new prices kick in, until we basically get to a more stable pricing and gross profit situation on the US sales. And this will be early in the new year as there's an inventory turnover period and order backlog period, turnover period until the new pricing takes hold. There's a slight additional risk if the Asian currencies as well as the US dollar were to go a bit weaker until September 30th. We have embedded current spot rates at about 115, 116 to the dollar, but do not have a lot of margin of safety for things to potentially get worse. So we need to keep an eye on potential devaluation of the currencies as a small risk to our guidance. In the next years, a gradual increase in the EBITA margin is being targeted, supported by the increasing share of recurring revenue, which is already at 51% for the group and 60% plus for ophthalmology, but should have further upside potential. We will also keep a tight control on costs, particularly on R&D. R&D productivity is key and will be further fine-tuned in the next years as we will define our priorities under our new management that has taken office with the CEO change to Max 1st on June 1st. The productivity of R&D will be focused as well as the efficiency of our operational footprint and a review of the different categories of the portfolio where in the last years we have seen an erosion of profit. The long-term sustainable potential for the EBITA margin, therefore, is seen unchanged in the region of 16 to 20%. And please stay tuned for the upcoming months as we will unveil more of our strategy on how to improve profitability and accelerate growth in the next couple of years. So thank you for your interest in Zeiss Meditec and hope to be speaking to some of you live as well as this format in the future again. Many thanks and looking forward to the dialogue with you.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.